The retail investor is being protected, but they've also been protected into poverty.
There's some regulation changes. Matter of fact, some that are happening as we speak that are allowing the average investor to literally invest like the institutions can.
Equity truly is the new money in the entrepreneurial revolution because there's no other asset class that can grow in value the way private securities can. When you support or invest in a startup, you're actually creating value in the world. That's why there's money there.
Mona, so one of the things that I love that you do is you bring things that are only available to the big investors, the institutional investors, but you bring that down to the little guys, because I can't help but to think that the average investor gets screwed. They don't have access to the investments that the big guys do that make them the real money. So they're always just spinning their wheels, trying to make a couple percent. And a lot of times it doesn't even keep up with inflation. Like, why is the system so rigged against the retail investor?
Well, honestly, we're in a capitalist society, right? That's what a capitalist society is supposed to do, is follow the money. And so that's what Wall Street does. And the system changed dramatically. So I spent 10 years from 91 to 2000, very early in my career, helping 4 tech companies go public and manage their investor relations, public relations, communications, and corporate development. And half our shareholder base were retail investors, just 3 to 5 years after founding. So the little guy could get in. The little guy did have access. There were also small boutique banks that did most of the tech IPOs. Most of these IPOs came out with under 100 million allocation. That's now a Series B. It's kept private. And the reason the little guy, this Main Street investor, isn't in the private market or hasn't been traditionally, it was really to protect them on the one level. The SEC wanted to protect from these high risk investments that don't have liquidity because they're not sold on the public market. And there isn't a lot of transparency. They're private. There isn't a lot of information out there. So 2 things are true: that yes, the retail investor is being protected, but they've also been protected into poverty, of sorts.
That's a good way to look at it. I love that.
Yeah.
Like
yeah,
they've been protected so much that it's kept them poor and kept them broke and feeling like they're always chasing their tail. That's interesting.
It's kept them safe while those able to take the risk have grown and grown and grown exponentially, because the private markets have delivered 70% or higher returns year over year for most of the last 25 years. Yeah.
So, I mean, if people just hear that, if, the people listening to this just hear that the private markets have returned 70% year over year, they're like, I want some of that. But there's a bunch of risks with the private markets. And I've been in this business 22 years, so I've seen those risks. And a lot of those risks are things like liquidity. You put money into a private investment, and if you need that money back, something happens and you need it, you can't get it. It's just not liquid. Now, the returns might be there, but the liquidity is a major factor. And the average person investing, they're just not educated on how to invest like the big guys, like the institutions. So I know you're doing a lot of stuff with that. And I also know, because you showed me an article, that there's some regulation changes. Matter of fact, some that are happening as we speak that are allowing the average investor to literally invest like the institutions can and invest in private equity in these investments that produce big returns. So talk to me a little bit about these changes and kind of how are you involved with all this?
Yeah, exactly. Thank you for that. On August 7th of 2025, the White House issued an executive order to democratize access for retail investors into alternative assets. And that asset class includes private market investments. It also includes real estate and things like crypto, minerals, gold, silver, things like that. So now for the first time, investors had access through their 401ks.
But you're not talking about self-directed 401ks. You're talking about just the standard off-the-shelf 401k for somebody that works for XYZ company.
Correct. So
okay, just wanted to make sure we were clear, because that's a lot of people would think it's self-directed.
Well, now what you can do, because in order for anyone to invest, any Main Street investor, they have to create a self-directed IRA, a custodian account. So not your Charles Schwab self-directed IRA, which allows you to be in the public markets, but now you can move some of your 401k assets. It's complicated. This is why the retail investor isn't in there. It requires education. It requires visibility and access. And then you need deal flow. I mean, this stuff is complicated. And most of it has functioned on, preferential access. This VC fund has the best deals. This one doesn't have as much access. We believe in a different model. We believe that the more people have access, the more everybody benefits and prospers. And that's the world that I have seen and operated in for the last 30 some years in this industry. And that's what I'm helping to facilitate. So this White House executive order is real. And what it allows people to do, like Blackstone, Vanguard, a lot of people have their 401ks with Fidelity and so on. Now those funds, those registered investment advisors, can now put private investment in your 401k. So you need to be aware of what is going in there. Some people are very much against it. Some people are very much for it. There's a lot of confusion. There's a lot of potential risk. So first step is get informed, become as educated as you possibly can, and be wise. Have an option to opt out. Ask your 401k if you want to opt out. And then if you're one of the people who's very actively involved in their wealth creation and preservation, you may want to take some of your 401k assets, open a custodian account, a self-directed custodian account. We have a partner that we've partnered with who's the best in the industry and the market leader. And we want to help people take control of their lives, just like you do with your audience. And then now that 401k gets transferred over without, still protected, tax-free until you retire. And now you're able to make decisions, especially if you're not going to be touching this money for 10 or 20 years or more. The liquidity risk is less of a risk for you. And it's more about the opportunity to benefit from those 70% potential gains or higher.
You just hit on something that was really important. I want to make sure everybody, hears this, because sometimes it just kind of runs over. Is you were earlier we talked about liquidity risk, which is a real risk with private investing. But then you talked about, if you did it with your 401k, I mean, someone in their 30s, I mean, they got a 30-year run in that 401k. So that money's just going to sit there anyway. They don't need the liquidity of the 401k because it's meant to grow for the retirement, and they can't access it till 59 and a half without penalty. So that's a really important thing. So the liquidity risk isn't as much of a risk if we've got the time horizon for the retirement planning. So then those returns really start to shine.
Correct. And even when you retire, or take access at 59 and a half, you're not going to spend it all at once. You're going to, take a couple decades, to wind that down. So it's less of a risk for you in that sense. However, it's still a risk for the people who have invested, because the private equity industries, which includes venture capital as an earlier stage, part of that asset class, they are going through a liquidity crisis right now. So don't, be just focused on the 70% higher returns. No, we're all humans at the end of the day. There's greed and fear that runs the money market a lot of the time. And there's people now who are sitting on all these assets. The public market plumbing has been messed up for 25 years. This is my area of expertise. I created the private market concept, built the first platform that's been acquired twice now, part of the NASDAQ private market. It was valued, at over $1 billion with all the top names in the industry investing into it. So I know what I'm talking about, but liquidity risk is very real where the industry is now. And you see many of the companies they've invested it in going public at a much lower price than their last private price.
Explain that a little bit, just so that everybody understands that. I know we talked about that, but just kind of unpack that piece a little bit.
Yeah, so the way things work with private companies is complicated. It's not like a public company. Everybody invests in one class of stock. Usually it's a common stock, and everybody's buying and selling the same class of stock. Just like this is a $5 bill, this is a $10 bill. There's a some fixed aspects to it. With a private company, you start out and do a pre-seed round. So that's your first series. The company may be valued at 10 million to start, and the stock has a certain price per share, or it can be done on a note level. See, this is where it gets complicated. Then as the company grows, you get next levels of investment, and now the price per share can grow to $1 or $2 a share, and then to $5 a share and $10 a share. So a company can very quickly grow from 10 million market cap to 50 million to 200 million to $1 billion to 20 billion. And so equity truly is the new money in the entrepreneurial revolution, because there's no other asset class that can grow in value the way that private securities can, or really it's entrepreneurial companies, whether it's private or public. The reason being that they're actually creating real value. Crypto to me is more like gambling because it's not really attached to real.
I totally agree.
Yeah,
Totally
it's
agree.
not attached to
No
real value, right?
intrinsic value. There's zero
You can
intrinsic
gamble
value.
and make money.
I'm
Something
a
like
Warren Buffett
1%
guy.
can make,
If it doesn't
yeah.
have fundamentals, I want nothing to do with it.
Exactly. That's how I feel. Although the professional poker players may, have a different view, but, the house always wins, in other areas. So rather than gambling, what entrepreneurs do is they find a problem in the world and they create a solution. They're very creative, create a solution, and that solution has value. And you only make money when you actually deliver that value and put it into people's hands. Then they want to give you value back, and then that value grows. So when you support, or invest in a startup, you're actually creating value in the world. That's why there's money there. And this has actually been America's growth engine. This has been the primary economic growth engine. If you look at what's the top companies in the stock market, they're all entrepreneurial tech companies:
Yep.
Google, Apple, Tesla, Intel, NVIDIA, the list goes on. And if you look at the Forbes billionaire list to see how did the billionaires make their money, they did it by starting companies, most of them. And then there's some that have inherited it from an ancestor who started a company. So this has been the primary way to create great wealth and generational wealth in the world. And some people have been able to do it by investing, and some people just by getting a job. Like, is the famous story of the secretary of the Google founders. And the Google founders are very generous. They gave every employee stock in the company. In fact, it forced them to go public early because the SEC had I think at the time, a 500 shareholder rule. And so they had to go public, whether they liked it or not. They actually increased that rule to 2,000 or 5,000 for Facebook. And people called it the Facebook rule for a while. Mm-hmm. So there's all these rules, and regulations that are there. They get stacked upon each other. So it's like you're building a house with all these stacks. And then sometimes you have to go in and just clean out the house, take it down to the studs, clean it up, make sure the plumbing and the electric. Sometimes you have to put in new plumbing and electric, when you renovate a house. And I think that's the point where we are now, is needing to, renovate and clear this system. But if you get in early, the earliest investors are the ones who make the biggest returns. That Google secretary retired with, I don't know the exact amount, but it was tens of millions. She was able to retire completely at a young age. She became a philanthropist and was able to live her life, helping other people, which made her very happy. And by the way, that's what makes me happy. I'm doing it through my work right now. And I realize that my work is giving me the greatest opportunity for philanthropy to make a difference in the world. And I want to just get this engine back on the tracks. I was asked to come to Silicon Valley in 2007 to fix the IPO crisis, created the private markets. We were very much on track. And our goal was to help companies go public earlier and give them the support that was now missing in the markets. And so that's how, the price grows very quickly and, rapidly. And then once a company matures, the growth slows. So if you wait too long, it's just like, a farmer harvesting. You have the seed investment, you nurture, you fertilize, it grows, and then you have to harvest. And if you don't harvest, it'll die on the vine. And we've seen that happen where companies, get too much competition. They're not growing at as fast.
Yeah, almost
rate.
every automobile manufacturer. I mean, look at any automobile manufacturer stock. Like, it's literally anemic. Like, you get your dividend, but like they can't grow. So it's almost surprising that people invest in those. And it's like, you look at Warren Buffett right now, looking at the entire market, he's sitting on, I can't remember the number, almost 400 billion in cash. He just trimmed his Apple position even more, bought a little bit. Someone was like, yeah, he sold his Apple, but then he bought New York Times. And I'm like, did you do the math? He did like 360 million in New York Times and like 4 billion, or I can't remember if it was 4 or 40 billion of Apple stock. It's like, you're talking about like, here's a 10 spot versus here's, $10,000. It's like a big difference here. But, I think it's interesting because Warren has access to these private investments. He has access to get in early. And I know one of your big things is creating the platform, the awareness, and the education for people to not only become aware of the risks and how to navigate the private markets, but also how to actually access these types of investments. Because as you know, the average financial advisor, they're not allowed to talk about this stuff. Most broker dealers are going to call that selling away. You know, the true fiduciary RIAs, like private money club wealth advisors, like they're just fiduciaries, they'll have access to this, but you know, it's just, they have access, but then the client needs the education to know, like, here's all the different things that go along with this. But you're doing a good job of solving these things and creating that transparency in the private markets. So can we just kind of go down that rabbit hole just a little bit? Because it's really fascinating. And sorry, I'm going to go one more level deeper. I've been in this business 22 years. I was an advisor for a long time. You know, now, you know, just a lot of stuff going on and I see it all, but like the market, it's broken. The system's literally rigged. It's just the average person doesn't have a fighting chance. And, you know, and right now I know a lot of people are listening to this, you know, that are invested and like, what are you talking about, Chris? I'm up 28% in my 401k. Listen, like, I get it. Like, we've been in the longest bull run in history, but there will come a time, I don't know when, because you can't time the market, but in the future where it course corrects you and you won't be saying that anymore. Like, it just has a levelizing effect. But if you were having access to these I don't want to call them alternates, but these private investments, these IPOs, this whole different world that the people like Warren Buffett and the institutions did, and you were to diversify some of the assets into this, that would carry you through these times, because the returns are so much greater that you wouldn't be worrying about the 20, 30% drops during recession times. You'd have these private investments, which is it picked your whole portfolio up. Now I know today they you know, oh, you got to have 60% risk on assets, 40% risk off, or equities to bonds. But like that model was proven wrong during 2008. So it's like, what chance do investors have, and how do we get them course corrected?
Yeah. Very good. You know, so yes, you may be up 28%. My son tells me the same thing. Oh, you know, I'm up 300%. But the point is, if there's others out there who may be up 60% while you're up 28%, you're never going to catch up. I mean, I don't know if anybody's been grocery shopping lately. My coffee's up 50%. My, you know, the tires I just bought are up about 50%. Like everything, you know, is just, prices are sky high. So if you don't keep up with it, you may think you're doing fine, but the rest of the world is going up much, much higher. And the statistics are there. They've been showing since the late 90s, the wealth divide has just been creeping and creeping and creeping. And so we've definitely moved into, you know, two worlds. There's two Americas. We know that. Politically, there's two Americas. There's a lot of fear economically. What's happening with us, and nobody can understand it, is actually a reflection of what's happening in the wealth divide. And it goes right back to the core of the public and private markets and this loss of access. So I really believe we're going to be fixing a lot more than just, you know, people's wealth. The money does make the world go around, and it's very important. But we're also going to be delivering capital formation or funding to startups, because this is where the jobs are being created.
Correct.
This is the high growth. This is, and it's not just jobs and money and wealth creation. It's also America's global leadership. You know, we are able to do what we do because we innovate. China copies what we do, right? They don't have that creative, innovative culture, you know. And I remember Condoleezza Rice speaking about this 15 years ago. I heard her lecture at Stanford, and I was so impressed. And she said, you know, this is, you know, what America is a concept, you know, and having this freedom. And, you know, Thomas Jefferson put the US patent system, he wrote it in, he baked it into the original infrastructure of this company. So the ability to have, you know, the intellectual property protection, to have that patent for 17 years. So you're going to spend millions or billions of dollars getting a drug to market, or, you know, a cancer solution to market. And that patent gives you a little bit of protection so you can get your money back. So you can make it worth the risk that it takes to all those years of clinical trials and FDA approvals and so on. And I'm here in Silicon Valley. There is no limit to the creativity that's here, the solutions, you know, the housing crisis, you know, climate issues, farming issues, everything, wealth access, what I've been focused on. There is no limit to creativity, but only 0.05% of startups seeking venture capital actually get funded. So you have
I didn't know it was that low.
I didn't either. I thought it was 10%.
Holy crap, I thought it was way more than that.
I did too. But what you're seeing, especially now with the AI bubble, Wall Street creates these bubbles. We've seen it. That's why the SEC was created. It was the 1929 bubble. And then more recently, we had the internet bubble came at the end of my public career. It was just insane. I was my last.
That was a
company,
doozy.
Yeah, I was employee number 24, 4 months after the company was founded, took it public at a $5 billion valuation 18 months later. And I left because I knew it was going to, I suspected, my gut was telling me it was going to be bankrupt. And if 18 months later it was, I mean, they were able to get out.
So $5 billion to nothing in how long?
Yeah, well, the whole internet bubble crashed.
I remember.
So
I lived through it. I almost went bankrupt.
Yeah, I mean, eventually they were acquired by AT&T, but it's, and then they had bankruptcy protection. It's protection there to protect everyone. And then eventually they were able to climb out of that and do, create value for the shareholders. But, it's complicated. And so that's why we're here. So the way that I do it is I do it as a media company. I've always done investor relations, public relations, and comms. Investor relations is like PR for investors. So it's talking to the institutional investors, to the investment bankers, very focused on, the large professional players. But half of my shareholders, when companies went public in 3 to 5 years in the 70s, 80s, and 90s, as we grew the economy in such a massive way, and especially in the 90s, the golden age of VC, everybody made money. A founder could have 2 or 3 companies in 10 years. The employees made money, the founders made money, the shareholders made money, the public investors made money. Everybody did very well. And then the big banks started noticing this was happening, and they came in and consolidated the small banks that paid attention to the smaller deals. And we also had some changes with Sarbanes-Oxley, made going public very expensive. So now deals had to get bigger. So the big banks wanted bigger deals for their bigger hedge fund clients. And then Sarbanes-Oxley's costs made it have to go bigger. And then we lost the small bank support for the small stocks. So if you went public, there was nobody writing about you and promoting you to institutions. And then the death knell, I believe, came in 2001 when decimalization was approved. So the stock markets used to trade in quarters, if you recall, and then it went to, decimals. And so all of a sudden, people thought, oh, we're saving money for consumers. They don't have to pay 25 cents a share to trade Microsoft. Now it'll be less. And the onset of trading online and E-Trade and stock trade and Ameritrade lowered those stockbroker commissions. And stockbrokers used to represent the retail investors and help them get into deal and give them access. And they did the sales and marketing.
I lived through that, but I never connected the dots on that.
Nobody does. The VCs, the VCs don't even know.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club is for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
You said that, I'm like, holy shit. Like, you just, like, I never paired that up, but you're right. Like, when I was younger, because I'm 48 now, so I've lived through these different things, and I was of an old enough age to feel the impact. I was a business owner during the dot-com crash, and my business almost went under. And that's how I got into the Wall Street world, is I needed a job because I couldn't afford my lease payment and I couldn't afford pizza. So I had to get a job, and I put my resume out, and that's why I became an advisor. But anyway, what I was getting at is you just explained, like, back then, I remember getting calls from various stockbrokers. And I used to throw, a couple $100 here, a couple $100 there. But these were like they made them sound so good. And if anyone's seen Wolf of Wall Street, it was kind of like those kind of pitches. But looking back, I wish I would have remembered these. Looking back, I bet you some of those stocks that I was being pitched or that I bought went on to be multi-billion-dollar companies that I would have probably made millions of dollars off of $1,000 investment.
Probably. Yeah, there's many, many of those. And we'll be putting out social posts and stuff explaining that, and also showing the losses. You have to show both sides.
Well, yeah, you got to be transparent on both sides.
Eyes wide open. Yeah, and my parents are the same. They were college professors. They had a stockbroker who say, buy this, sell this, and they did what he said. And they made money over time. They had a couple losses, and we got to hear about it occasionally at the dinner table. And but all that went away. All that infrastructure was lost because now a stockbroker, I mean, he's they're usually a person with a family they have to feed at the end of the day. And if they
there really isn't stockbrokers anymore, they're gone.
They're gone because you go from 25 cents a share to fractions of a penny, and you can't make 2,500 more hours in a day. So they became wealth managers. So now retail became disenfranchised in 2001. And only the ultra high net worth were supported. And so VCs called me in 2007. I just finished raising a $500 million fund in DC. And one of them was involved and said, okay, now come here and fix the IPO crisis. And I was dying to come to California since, I went to college. And so here's my shot. And I came out and I was all excited, to have a big project. And we did. I created this concept, named it the private market. It was never called that before. But, VCs had 7, 8, 9 companies that would have, should have been public, and they couldn't go public. They couldn't get returns. They couldn't raise money. They had a liquidity crisis. So we wanted to restore liquidity and bring back IPOs or the exits, because that's how you make money. It's like a farmer. You can't leave the wheat on the stalk. You have to harvest it. You have to sell it. And that's how these investments are usually made. And these are structures, these are securities that are structured. So you can create new structures. You can, just like, a house built 100 years ago, the plumbing and electric were very different. You can update it. But you have to go in and clean it out. You can't just keep loading more electric and plumbing on the old stuff, which is what happens in government sometimes, becomes top heavy. And I think there's really good people in Congress and the SEC and the White House very sincerely is focused on creating more economic growth and more wealth for Main Street investors. So there's really good people there. In fact, I have a letter in draft I'm trying to get out to just add a couple more things to it to support the IPOs and to help the legislators in the Senate Banking Committee. It's already been approved. There's an omnibus of 22 bills that's been approved from the House. One of the bills is a new accredited investor exam. So if you're accredited, which has been defined historically as someone with enough net worth, or they added sophistication. If you work for a tech company, now you might know more. Now you're allowed to get into these riskier investments because we want to protect the small guy who doesn't know and could be taken advantage of and could lose their money. So it's a good thing that they're protected, but at the same time, again, they don't have the rise up opportunity. And so now for the first time, you can take this exam and you can be an accredited investor. So you can switch from being rich enough to be able to lose your money safely to now being smart enough to not lose your money in the first place. And this is what you do.
And this is happening people right now? Like this exam is available now? And
well, no, this is
okay.
HR 3339.
Okay.
It passed the House July 21. It's in the Senate, and it got included to the INVEST Act, which is 22 bills that collectively together are changing bits and pieces here and there. But this one is very important because it's focused on education. And to me, I start with education first.
Always,
I'm the daughter
yes.
of 2 professors.
Same here.
Yeah. So, and that's what you do. I mean, that's the great value that you deliver to the world in this
same to you. I mean, we both do the same
world of Wall
thing.
Street, right? So having this exam, it's going to be like a driver's test, but a very rigorous one. We don't want people on the road who can't drive because it'll endanger everybody. They endanger property, and that's can be what's happening. And we don't want people speeding and hurting themselves. So in the same way, if people can now become educated, take this rigorous exam, study for quite some time to do it. We would like at Radavision, this is my 4th startup now, to also be an exam prep vendor. So we're already providing much information. So this would just be the next level. And we want to prepare people so they can pass this exam. And then we also have a ton of content. We're a media company. We're not a broker dealer or a registered investment advisor. These are all SEC licenses. And we want to work with these, all of these folks. So we're a media company like ESPN. We focus on startups instead of sports. And then if people want to make a sports bet on ESPN, this is a regulated activity. So then ESPN refers them to DraftKings, which is an entity that follows the regulations and is able to execute. So they have a partnership. And it's worth, last time it was published, it was over $3 billion a year in referrals. And that's what we do. We're a media company. We focus on startups. We want everybody to be able to come in and say, I want to look at startups focused on curing cancer or fixing the housing crisis or, things I believe in or areas that I'm interested in. And we want everybody, all the startups to have a presence, just like LinkedIn or Instagram. We're a social media site. And these are real companies telling their real stories and then also giving weekly updates through our bites, their little news bites, so you can keep track of how the company's growing, what they're doing, and you can follow them and they'll show up in your feed. We have a new Angel Wallet app that'll be released with a big launch in a few months. and you'll be able to track it. So it's like Apple Wallet meets TikTok, and the TikToks are our bites of the news bites. And so we want to make it easy and fun and engaging, just like Shark Tank, is really the only way that consumers have today to connect to the startup world, and those of us professionals in the business cringe at Shark Tank, but the reality is it's been a 15-season Shark Tank effect.
Wild.
One pitch for 5 or 10 minutes can move millions of dollars of sales for that company. So we're not just all about investing, we're about telling the story of the company from the real people who've built it, and then keeping in touch on a weekly basis. So this provides a lot of transparency. So it's going to be very hard to hide behind Ponzi schemes and BS, if you don't have the real news to share. Most of that fraud, those are the 1 in a million, you hear those headlines. You don't see the other, 100,000 that are actually producing all the good work and can't get the funding that they need. And so many founders, including me, we've wasted so much time, trying to get the funding as opposed to actually running our company. So this is a massive asset for America to improve, our lives and the lives of humanity that's being wasted because the plumbing of capital formation is broken. And so all of these bills that are now sitting in the Senate and ready for review are focused on capital formation for the companies to help them grow, create economic growth and jobs, and create wealth, generational wealth for everybody involved, including the employees who can get stock options, and then those investors who can come in. And it's focused on making it safer for retail investors and giving them access. And so all I'm proposing is there's just 2 or 3 little areas to harmonize to allow, for example, retail investors to get into IPOs. What does IPO stand for? Initial public offering. So the company's private, and then they're going to go public. Well, guess what? 100% of that IPO allocation, traditionally or since the last 25 years, is going to institutions that are privately held. There's no there's no public going in anymore. There used to be Merrill Lynch and the stockbrokers who would put in 20% allocation.
I used to get calls all the time. Hey, we got this IPO. Do you want to get in on it?
Exactly. And for the last 10, 14 years, a lot of people have been getting phone calls. Oh, this company's going to go public, get in now while it's private. And then none of them are going public. So I have, investors in my company are like, I'm holding on 10 years and nobody's going public. And it's a problem.
You showed me a sheet, like before we went to do this podcast, you showed me like a sheet. Do you want to pull that up now so that people can see it?
It's an infographic because this is complicated, right? It takes a lot of words to explain.
But it tells the story of the wealth divide and how that's playing into everything going on. I think this is fantastic. Democratizing the private markets is the name of this, folks. Yeah. If you're not watching it, if you're listening. We want
everybody to have access. And that's actually the White House executive order is about democratizing access. And so what we want to show here is, this is a chart that Blackstone submitted in 2019 showing how their private equity investments have delivered 14% compared to the public markets at 8%. So that's a 70% higher return from the public markets that those able to get into a Blackstone fund could deliver. And then you can see the wealth divide here. I mean, it's been gradually, coming down over time, but really accelerating in the last 30 years as the venture industry became more robust and more people understood and came into entrepreneurship. So those people with access who are considered qualified institutional buyers, those are institutions with 100 million plus, or institutional buyers or even accredited investors who have a high net worth, safe enough for them to invest and lose their money and be okay, are able to get in. The rest are working hard, taking care of their families, have retirement funds, but without exposure, just by doing their work on a relative basis, they're going down, even though they might be going up. This one's going up so much faster that in reality, the wealth divide is greater. I mean, when I moved to Silicon Valley 17 years ago, you could get a good house for $1 million, and now that's the same house is 3 to even 7 million, depending on where you are. I actually went to my old neighborhood and wanted to get my daughter a house, and now they're up to 7 million, which is so. This
is what Silicon Valley looks like nowadays. It's that bad.
Oh yeah. Well, if you want to be in Palo Alto, everybody wants to be in Palo Alto. Wow. It's a very small area. Yeah. So but there's lots of other places that are more reasonable. But a good starter house here is well over 2 million. In most of the locations. Wow. But then you're looking at engineers making, 300,000-400,000 before their equity. And then you also have the new AI folks who are making 700,000, 3,000, because there's a bubble, right? So everybody's overpaying, and that's a whole other episode. I'd be happy to come back and talk to you about that.
That'd be a fascinating one.
It would be, and there's a lot of people talking about it. But this is like, if you look at the public markets pre-2000, when the bubble burst and, you know, the big banks had come in and all these things happened, and that story is not even in here. But you had 7,500 public companies. So people had a lot to choose from. Companies were public in 3 to 5 years. So a lot of that rise up was accessible to everybody. Now we have fewer than half the companies. I mean, even Jamie Dimon, the CEO of JP Morgan, the largest investment bank in the world, says companies aren't going public anymore. Even he's struggling with this, right? And it's hard to see it when you're inside of it because they're so successful no matter what happens. But it's easier to see when you're on the outside. And I think that's part of the reason I see it more clearly, is having that big picture. So with fewer public companies, and then also most of the, like, it's now, I think that, you know, I did this infographic like 20 years ago. I'm sorry, in 2021. So about 5 years ago, I started it, and I've tried to update the numbers. There's like 7 stocks that have about 30 to 35% of the total value of the stock market. It's like, that's really unhealthy, you know, to have that. It's so concentrated.
Do you know that the only other time that's ever happened in history is right before the Great Depression?
I'm not surprised. So there's a blockage, but it's a plumbing blockage. This is like, we need to call Roto-Rooter. You know, this isn't brain surgery.
I know a guy.
Yeah. I know you know a few. So basically, the SEC has been working since 2000 to create opportunities to bring retail in. They created Regulation CF, crowdfunding. In 2016, that was approved. They have Regulation A+, which was and A, which were approved in 2015, and they continue to incrementally improve these. But crowdfunding is collectively bringing in only like a billion and a half a year, which is a fraction of the 300 to 400 billion that's been invested in AI in the last year alone. Okay, and anybody who's not AI, good luck. You really have to have a very mature company, and then people are willing to come in right at the end after there's all the risk has come out of it. You know, you're strong, you're growing. It's just that last little bit of growth. But it's very hard to get that beginning initial funding that you need. But if you look at U.S. retail wealth, you're talking about $98 trillion in people's 401ks and IRAs. This is managed wealth. So people can have savings accounts, they can have real estate investments. That's not necessarily included, but this is managed wealth, according to the U.S. Federal Reserve Q3 numbers from 2025. And you compare that to what's in the venture world right now, it is massively larger. So we think of the little guys, they ain't so little. This is pretty big. So this is transformative. And you bring the little guys together. We know that the power of many, especially when educated and, you know, well-informed and can have access, it can be very, very powerful. Now, of course, you don't want to put your entire retirement in there. You want to have an allocation. So at the most, usually a registered investment advisor will say 20%, usually 5 to 20%, depending how close you are to retirement, if you have kids for college and what your risk profile is. So an advisor will tell you that. We're a media company. We don't tell you that. And then these are the risks. So if you're not educated, if you don't have professional managers, so Alpha represents, you know, fund manager, someone like you who has a lot of knowledge and information. So if people can follow you, they're going to be in better shape than if they try to do it on their own. To diversify your portfolio, we know how important that is. Venture capitalists will invest in 20 companies in a fund. They only expect one to really be a breakaway, like a Facebook or a Palantir or a Google. And that's all you need. It'll pay off all of the rest. And there may be 3, 4, 5 that do well. And then there's a whole bunch that just don't break through the ceiling. And it's okay, because you can have thousands of percent or tens of thousands of percent returns from the one that more than cover the rest of the portfolio. Having good general partners and advisors with their reserves, their skin in the game, puts you on the same level as them. And that gives you protection, because they'll protect themselves. You're protected along with them. Having limits on the portfolio again. We discussed. And then, of course, liquidity is the most important one. So here, only IPOs have true liquidity. Now, the secondary market, so the company that I originally built, the acquirers focused only on secondaries. That only gives you a certain amount of liquidity. So the professionals have used this as a way to keep liquidity going, but that can be a hot potato game, right? So if you're the last person holding the hot potato when the game crashes, which is where we are now, you know, for the last, it crashed around 22. So a lot of the companies going public now are going out at half the value or less. So those people who are the last investors in, it's going to take years more growth before they can actually get their original investment out. They've lost. So we don't want to be in that position. We want to help these companies go public. So the private market only has true value with a robust public market. The whole world needs robust public markets. That's one of America's greatest assets, is we have the biggest and best public markets in the world. And that's why companies come to go public on the New York Stock Exchange and the NASDAQ. So we need to really protect those and protect that ability and get that plumbing organized. And so this is the main point that I'm making in the letter that I'm writing to really help the IPOs and to bring more retail into IPOs again, because that's the most protected. We could even require, that or aim for that, so that every IPO has an allocation for retail. And if you look at IPOs, I'm actually preparing a white paper on this. The ones who have done the best have organized retail investors. So like Reddit was able to come in under the sophisticated investors by bringing in their top users of their platform and offering them shares. And they, even though they went public at half the valuation of their last private valuation, they have done very well because, of course, they have a whole social network that keeps everyone engaged. And we're aware of Wall Street bets. You saw what happened with GameStop in 2020, when you got retail organized, and this was a public company, right? But if you organize people and inform them and they act in concert, like a school of fish or a flock of birds, the power is great. And that's what we're trying to do is inform people and integrate the small investor into the larger ecosystem. We don't want the larger players to fail. We want private equity to succeed. We want venture capital to succeed. We want the stock markets to succeed. We want the small players to succeed. And, if you look at this 98 trillion in wealth, 5 to 20%, the midpoint 12.5% is 12 trillion US, 12 trillion. And there's going to be an equal amount or more internationally because they don't even have access to US like we do. So you're talking $24 trillion of new potential investment coming into fund innovation, which will keep, America, at the highest innovation levels, totally support our global leadership, totally support economic growth. So if we can get this plumbing and electric right, we can actually usher in a new golden age, a new renaissance, similar to what happened after, World War I and World War II. I mean, we were in the exact same situation, by the way, 100 years ago. We had, what did they call it? The Gilded Age,
The Gilded Age, yeah.
Because we went from the agricultural revolution into the industrial revolution, and those with access to the new economy were creating value greater than ever with steel and the skyscrapers, railroads, and those are the folks who made the money. And then the financiers, the Morgans and Mellons who financed them. And those were the rulers, the robber barons. Now it's the Musks and Bezos and Gates and so on. We're in the entrepreneurial revolution now. This is, equity is the new money, truly, in the entrepreneurial revolution. I've been saying this for 10 years, but it's truer now more than ever. So those with access have this ability, and we had the exact same wealth divide, and people were suffering in a huge way. We had the bread lines, through the Great Depression, because Wall Street abused their power and created the collapse. And that's why the SEC was created, to protect small investors from that. But all that economic pressure, the fear, the hatred, created World War I, World War II. We even had the Spanish flu in the middle, like we had COVID. So we're literally cycling through very similar scenarios.
What do you think is next? I mean, so, because you're kind of taking us through these different ages and these different cycles.
Right.
What do you think end of 2026, 2027 brings? What are your thoughts?
I don't know how quickly we can do this, but my hope is we cycle what happened then without, the whole World War II and the concentration camps and all that.
Right on the verge of Trump saying he's going to attack Iran.
We're kind of in a war now, right? It's done digitally, it's done online. Yep. I mean, there's a lot of pain and suffering, a lot of the suffering that we're going through, the tariffs and the supply chain, we had bread lines back then. So it's an echo. It's not louder than what happened before. It's a little bit less volume. So we're heading in the right direction. But what happened after that was the golden age. We opened up the world of consumerism. We had Mad Men, right? Ad Men advertising came out. Everybody had the beautiful Cadillac in the driveway and, washer and dryer. And we had so much wealth. We had the baby boom. Everybody was creating new babies, so that's what happens when this economic pressure finally cracked and broke, and then all this energy was unleashed, the energy of human creativity and abundance and prosperity. And so that's what I'm hoping is next. And this time we can do it more consciously because we have the 2020 hindsight of what happened before. And we have the wisdom to shift from the capital markets functioning on greed and fear and limited access. There isn't just one pie and you're having a piece of the pie is going to take away from my piece of the pie. No, you're informing me is going to make me grow my pie and your pie is going to grow in the process. The more prosperity there is for each person creates more prosperity.
I agree. It lifts all boats.
Right. And so hopefully we're shifting the consciousness to one of innovation, creativity, and growth, and understanding that it's not you're taking a piece of my pie and I'm losing, which is where mentality is stuck. And we're kind of devolving towards that. Instead, look forward and now find those things you believe in, find those companies, do your due diligence, have them reporting every week so you can see what's happening. And then everybody can grow together, and we want to be able to give retail access, not just to the public companies and the private companies, but why shouldn't someone be able to go into a Sequoia fund and be a part of the next Google from an early stage? Why shouldn't Sequoia, be willing to take 20% of their fund and allocate it to retail? It would seem like that's the American thing to do, So,
well, I think it's what you always say. It's just the knowledge gap. That's all it is. We got to close that knowledge gap. And
knowledge and then access. And that's what we do with Radavision, like ESPN. We want to show all the games. We want you to have the statistics. We want you to know what the star players are doing. We want to have shows where everybody gets to talk and you learn and grow by tuning in. And then, with the Angel Wallet also, you'll have the ability to share it with your friends and you can invest together in groups and see how things go. And hopefully we'll have a lot more IPOs coming out that everybody will be able to participate in.
Oh, I love it. I love it. I love everything you're working on. I truly, truly do.
And I feel the same about you. You're doing the hard work of getting that solid foundation so that people have enough to be able to do this level of investment. So thank you for your work.
You're welcome. Well, let me finish with this statement. And I've said this a lot. I don't know who originally said this, but it is so true. It's never going to be about your actual resources. It's going to be about how resourceful you can be. So folks, if you're listening to this, if you just heard Mona talk about all these amazing things, that's you getting resourceful, you getting around the right campfires, you learning and closing that knowledge gap. You want to get ahead. It's probably never going to get easier in your life to get ahead than right now, because all you need to do is just a little bit more than what everybody else is willing to do and learn just that little bit of extra knowledge that will set you free financially. And if you don't believe me, well, then just keep conforming to what everybody else tells you to do with your money and watch how that works out, because it's not working out well for the majority of the population, the 95%ers, as Earl Nightingale would call them. You want to be the 5%, folks. The only way to be the 5% is to create what you want, to create your dream, your financial destiny. And the only way to do that is to learn how and to get around people like Mona, get around people like myself, the other people out there teaching you the truth about money and how it really works. And Mona is definitely at the forefront of that. And I had it written down and I got to read this. I might be the person out there teaching people how to become the bank, and you are the one teaching people how to be their own angel investors. And I think that is super powerful. So thank you so much for what you do.
My pleasure. And thank you.
Hey, if people want to learn more about you, where would they find you?
They can go to radavision.com and the site is there. It's free to join. There's over 50,000 pieces of content on the site right now. We have original content. Pitch Planet has a few companies, a couple dozen on there, but we're soon going to be loading them on. There's going to be hundreds and thousands of companies. And then there's resources, like you said. So we have a Learn section. It has all the books on entrepreneurship, the newsletters, lots of opportunities. And we connected because I really wanted to incorporate the experts teaching financial literacy and the foundation, because people need to learn that first. So I hope that soon people will be able to access you on radavision.com.
Well, I hope so too, and we'll make that happen. But with that being said, folks, thank you so very much for joining us for this episode of Money School Elite. And you know what? We'll see you on the next one. Thanks, Mona.
Thank you.